Well, thanks for joining. A few points before I get started. If you have any questions, feel free to drop your questions in the chat. I will look at them and go back to the slides if it's regarding a particular slide, and our team will also be answering in the meantime. In case you're not able to stay for the whole webinar, it'll be recorded. We'll be publishing on our YouTube page tomorrow. Feel free to share it with your friends if you like it. And well, without further ado, I'll get started. So as you guys know, decentralized finance, DeFi, as you may know, has been one of the hottest topics within the crypto space this year. Some of you may be more aware of what it does and specifics. However, I'll do a brief introduction to it just to get everyone on the same page. And then I'll dive into the innovations and risks related to DeFi. And then I'll leave the core of the presentation to discuss analytics regarding DeFi. So specifically, I'll talk about the supply side analytics, which is the collateral that these protocols have, and the demand side, which is more related to the users and what they're doing with these protocols. Finally, I'll talk some more about the efforts we're doing at IntoTheBlock, a data-driven approach towards analyzing decentralized finance. And some of the results, I'll give you a sneak peek into the work we're doing in this area. All right, so let's start with a brief overview of decentralized finance. So some key characteristics of DeFi are that it's open in the sense that it's transparent, it's verifiable since it's open source, anyone can access it, it doesn't have KYC in nature, so you don't even need an ID to access these protocols. It's trustless in the sense that there is no central party managing these protocols. In a way, some of these protocols did initially have a foundation or a team running them, but they're all seeking to decentralize themselves to make the protocols even more trustless. And another key characteristic, which is less to its core, but more of a feature that we've seen, and it's a benefit from all being built within the same infrastructure, is that it's composable. So for this presentation, I'll discuss most of, when I talk about DeFi, I'll be referring to Ethereum-based decentralized financial applications, and that they have the benefit that they're composable since they're in a common ledger. They essentially are able to integrate with other applications within Ethereum. So as you can see, and as many of you might have heard, there's the metaphor of money Legos within DeFi. So essentially, you can use take advantage of some of the products and services that other decentralized applications have built, as is the case with Maker, DAO's DAI stablecoin is the most common example. And comparison with fintech companies, which have also been growing the past few decades, well, past decade or so, is that it's a completely different system. One, it's not open, even though some of these fintech companies are, to a certain extent, more transparent than banks. They still have the problems of having a central point of failure. So in that sense, you have to trust them. And they're not composable. Sure, they can have partnerships between companies, but it's not permissionless in the sense that in DeFi, you can completely, essentially plug and play with some of the solutions that are already pre-built within Ethereum. Some of the use cases within the area include lending and borrowing, as is the case for Compound and Aave, derivatives for synthetics and UMA, decentralized exchanges, so like Uniswap, asset management like token sets, and payments. A good example would be Flexa. So even though DeFi has been a very hot term this past few months, it has been this movement within decentralized finance has started, I would argue, since Bitcoin. Being peer-to-peer cash, if you think about it, it's probably the first application of decentralized finance. And I would argue that most of the protocols that are being built now within Ethereum are going along the same vision and ethos that Bitcoin started over 10 years ago. Before the term itself, DeFi, got going, a lot of people refer to it as open finance. That since has not become the common term to describe it. And there have been protocols building these types of solutions before DeFi, the term itself, existed, such as MakerDAO, ETHLend, which is now rebranded to Aave, Kyber, and of course all of these have been relatively successful, but there are also some examples that haven't been as successful, as is the case with South Lending, which was an ICO project in 2017. It almost reached $1 billion valuation, and it's 99% down its token, and along with it, its network activity. Finally, even before Ethereum, there was a protocol called Invictus Innovations, ran by Charles Hoskinson and Dan Larimer, who are in Cardano, well, IOHK, and EOS now, respectively. One of its products was BitShares, which was along one of the many services they provided was a decentralized exchange, or at least they were building towards that before the company parted ways. And I want to talk about the innovation going on. So there's certainly a lot of hype about the final vision of these products. But I would argue that there is actual innovation leading this hype, as well as actual products, which is a key difference between the ICO hype and now. One of the main innovations is that they align incentives without a central party. So I had mentioned probably the first example of this was Bitcoin, but within tokens built on top of a blockchain, this is probably the best, or at least the most used example of actual protocols being able to lead incentives this way. And so if you think about it and compare with utility tokens, which was people assumed that it was just money and that people would use their money to unlock utility within a smart contract. What the issue with those incentives is that the users would be constantly spending the tokens that they had, and so to unlock this utility, and there would be no value accrual by the networks. Whereas in DeFi, the tokenomics, or Ponzinomics, some people are calling now, are more based on people actually storing the tokens, and they earn values through staking, liquidity mining, or other incentives for actually holding the tokens, which is a key concept, and it mitigates the velocity problem, which is essentially what I was describing, that the utility tokens would be constantly spent and not accrue value. And finally, I guess I would say it's a step, even though it's still in the early days, towards providing financial services to the unbanked. So as I said, it's completely open. So in theory, people without a bank account should be able to get a loan in Aave or some of these protocols at the moment, even though it's still in the early days. And I would argue that the next step towards this vision is tokenizing real world assets, which is something I believe MakerDAO is doing, putting efforts towards. And so I imagine many of you guys were hoping I cover this hot topic of liquidity mining or yield farming. So I would argue one of the ways liquidity mining got started is that a lot of these financial protocols realized that they need liquidity in order to provide services that are actually usable Hi. It's not letting me start the video, unfortunately. I had an issue with my Wi-Fi. I had to connect through my phone. Sorry about the issue. Should be started right away. All right. Sorry about that, guys. Had a super convenient problem with my Wi-Fi shutting down. Anyways, can you guys see my screen? Let me see the chat. Okay. Sorry about that. My Wi-Fi somehow stopped working. Had to connect through my hotspot in my phone. Anyways, I'll go back. I'll speed up a bit for the few minutes. So liquidity mining creates incentives for these protocols for the users to provide liquidity to the protocols, and they're rewarded with tokens. These tokens are governance rights. Hi, Jesus. We can see you. Okay. And the governance is distributed through these tokens, which users can then use to vote for proposals in the decision-making process for the protocol's long-term, essentially, path. And it also creates a potential for accrual of value for token holders. So if the Compound protocol, for instance, would decide to charge fees, which I'm not saying it will, on the liquidity or the lending that it carries, possibly the token holders could vote to receive part of the value being created through an interest fee. And while this is a potential path, there has been some issues with the hype and some unintended consequences due to over-incentivizing the users. I'll explain that a bit further. So specifically about comp, I forgot to mention, even though yield farming has been a relatively recent hype, it has been around for over a year since Synthetics first tried it out with a Uniswap pool. The most common and most famous example of it, though, is the comp liquidity mining. And since essentially this happened in June 15, I believe it was, the liquidity locked within the protocol grew by over 8x to something like 900 million within 2 months. And the artificial liquidity and this liquidity supplied increase significantly. One second, I'm just going to read some comments in the chat that I think are related to what we're discussing. So Donna Riddle is asking, how do you determine who gets to vote if trading and ownership change rapidly? Great question, Donna. Thanks for joining us. So yes, the votes are distributed pro rata, in the sense that means that if you have more comp tokens, you have more power over the decision making. And even though the ownership does change very rapidly, my understanding is that it has to be locked by a specific point in time. And essentially it's when the limit of a proposal is submitted. I think depends by protocol. In Compound, I believe it's like you have 3 days. It's a relatively short amount of time for someone to look at the protocol and submit their votes, and they can't move these tokens. They're locked until the proposal is decided or voted by the users. Hope that answers the question. And going back to the comp case study, the token holders, so I would argue that they were able to effectively capture and distribute their governance and capture a community with over 20,000 token holders within less than 2 months, which is about the same amount of token holders that Maker has had for its MKR governance token with a lot more time. However, only 1,000 of those addresses have been actively voting. So that doesn't address the issue with voter turnout, essentially. So as I was hinting towards, there are unintended consequences with yield farming. So what yield farming is, essentially, it encourages liquidity. And some users have been essentially exploiting some of the systems within Compound or other protocols to essentially provide liquidity at all costs. And this, at first, when they just launched the liquidity mining, the first issue was that demand for low market cap tokens, basic attention token, essentially had the highest yield farming ROIs. So demand for basic attention tokens skyrocketed and the prices. And it was clear that that was bad for the tokens and artificial demand. And the other issue, which is a bit more worrying, in my opinion, is that users have been recycling the DAI. So currently, the market cap of C DAI, Compound DAI, is about 10 times greater than the market cap of actual DAI. And the way this has happened, and I believe they're taking steps towards mitigating this, is that they're essentially recycling DAI. They get a loan, they deposit their DAI in Compound, they borrow more DAI, they send it to another dApp, which is IntoTheBlock, because this functionality isn't, of course, you're not able to do it within Compound itself. And then you put that DAI again back into Compound, which essentially makes the loans that start as over-collateralized, it ends up being more like a fractional reserve system, which is not great. A few more questions, sorry. So there's a good question asking about bridging gaps between fiat and crypto. I think on-chain on-ramps from fiat to crypto are essential for these systems to thrive. I don't know a particular example off the top of my head, but there's definitely a lot of opportunity there. And yes, Donna, you're saying that we're recreating the ownership and voting that exists and considered in broken normal securities. Unfortunately, there has been a lot of complaints of these types of structures being recreated, since comp governance tokens are accrued the most by people supplying the most liquidity. So it does end up being less decentralized than token protocols would like. So there's a lot of issues with it, and I'm not saying it's perfect by any means. There's definitely a lot of risks, which takes me to my next slide. Given all the hype surrounding DeFi tokens, I thought it would be worth stating the risks. I'm not completely, of course, there are very apparent risks. I'm not saying they'll happen overnight, all of them at the same time, but I just want to clear out these risks. Of course, the main and the most obvious one is hacks. They have happened. People exploit smart contracts constantly. Some people consider those hacks or just people gaming the systems. Regardless, it can end in users losing all of their tokens. There's also the unpegging of stablecoins. So since a lot of the operations in DeFi happen backed by stablecoins, if you trust a third party like Tether, well, Bitfinex, and it's proven that they don't have the actual backing for their Tether stablecoin, then that would unpeg the stablecoin, which could cause liquidations, which is the next risk that could also happen due to low collateralization ratios. And there's also downsides to composability. So as I said, these are money Legos stacked on top of one another. So if there's an issue to the underlying infrastructure, be it Ethereum or maker, which is a bit, I would argue, a layer on top of it. If there's an issue in the lower level, essentially, the levels on top of it would also suffer the issues. And there's finally, with yield mining, the risks of yield farming bad harvest, which is essentially token prices going down. I have a few more questions, but I will get to them at the end, since we had a bit of a issue in the middle of the presentation. So regarding the DeFi tokens at the moment, as I said, they've definitely been overhyped, I would argue, by some of the investors. These are some of the year-to-date and returns since March 16. So even though they are getting traction, I would argue that it's mostly within the existing crypto space. And they have, especially since yield farming became such a hot topic, the returns on these tokens have gone through insane returns. So I would advise caution, of course, if you do decide to invest in this space. And going towards the metrics, of course, there's the supply side metrics. And I think one of the reasons total value locked has become so widespread is that it's a unifying metric for the space. So essentially, to use DeFi services at the moment, you need to provide collateral, since that's the only way to distribute the trust so far. And since they do use that, that's a supply needed to unlock the services that are provided within DeFi. Some of the limitations, however, the most obvious is that if you see it in USD terms, it's also very linked to the value of the tokens that are supplied. So not as relevant, I would argue. It definitely does not equal more users or adoption. For all we know, well, of course, we have more data on this, but it could be just the same amount of users providing more collateral and getting more services. There's a demand for incentives. So essentially, that people might be supplying, and this is one of the hidden issues with yield mining, that some of the people are actually supplying their liquidity, not because they want to use the services provided by DeFi, but rather because they just want the incentives, which is an issue, I would argue, because it encourages short-term behavior. And most collateral, since they're over-collateralized services, isn't actually useful in the sense that they're not providing the actual service that the users ideally look forward. Of course, they do provide the usefulness in terms of security, but it's not like the demand numbers, which I'll get into in a bit. And finally, as a final point for total value locked, I would argue that it's more of a metric of the total dollar value trusted within DeFi protocols. The demand side metrics, the issue is that they vary by protocol and use case. So if there is not one unifying metric like total value locked, and I guess that's also why it hasn't been as widespread. And specifically for decentralized exchanges, they since they require liquidity, of course, to operate and to provide trades with minimal slippage, I would argue that the best metrics to look at are volume, both in dollars and in token terms. In token terms, it's useful because, as I said, it tracks the actual amount supplied rather than how it varies. And as you know, being volatile crypto, that varies a lot. And the transactions. So this is a screenshot from Uniswap. The more transactions, of course, the more liquid, the more users are able to seamlessly trade within these protocols. And for lending protocols, I would argue that loans outstanding is a better metric than the total value locked, because it's what the demand for the actual services that are provided by these protocols. So the loans that are supplied is what actually matters to the end user. And it's the aggregate amount that would matter in that case. And active users, so of course, financial services are not usually something you'd use every day. So we're looking at metrics in IntoTheBlock more long-term, like weekly and monthly. and also like the unique lenders, the unique addresses using these services over time. I'll speed through this a bit more. I know I have some questions you guys want me to get into. So at IntoTheBlock, we currently have a insight section with articles, and we've been doing this massive effort for months now. That it's our next big release called Insights. We're revamping it completely, and it will have general categories. Essentially, one of these categories will be DeFi, and we want to provide an overview of the protocol's usage and adoption, as well as more generalized insights about the tokens themselves, and also on how to use them properly. So I have a question on ETH fees being prohibitive. Well, we want to provide, in short, yes, but we also want to provide analytics on how to make these less prohibitive. And so I want to show a preview of the work we're doing so far. So our UX team has done a fantastic effort on this. As you can see, we'll have multiple categories, including featured. And within DeFi, we have the money Lego here. Some of the analytics we're looking at include the total market cap and the dominance by each, the number of addresses. So this would be like the unique addresses with a balance of the DeFi tokens. There we can see the total aggregate market cap, the market share within tokens in the space, and possibly we're looking at adding the variations between one token and the other. So that's a sneak peek. It's still very much work in progress. Thanks for the positive feedback. Here's some good comments there. And I want to also discuss some of the other topics we're looking into. So one of the recent efforts our engineering team has done for one of our institutional partners is analyzing liquidity pool flows within Uniswap. So as I said, liquidity is essential. It's at the core of these protocols. And here we can see for Chainlink, even though they both have been, so this is liquidity in Uniswap for Chainlink pool and Chainlink's price. Even though both have been on an upward trend, there's several instances where there's a pretty noticeable negative correlation between the two. So I think these are important factors for traders to consider, since liquidity can exacerbate, or lack of liquidity can exacerbate price movements. Another thing we're looking at is, so as it's all built in Ethereum, most of DeFi I would argue, is the flows between one token and the other. We're hoping to aggregate this data to see essentially which way the money is flowing within the DeFi ecosystem. We're also looking at aggregating the DeFi market cap and dividing it over Ethereum to see a metric of the value market cap wise in DeFi as a total of Ethereum. As some of you have mentioned, we're looking, of course, at gas costs. So I would argue that Ethereum benefits from gas being spent. So since it essentially needs more Ethereum if you want to keep spending and using these protocols. So that's one of the things we're looking at, how much ETH is spent in gas. But also how, another thing we're considering is heat maps of how gas costs vary and what's the ideal time to use these protocols so that you essentially minimize your costs and maximize your profits, making them more usable for the end user. And brief conclusions. I think we're in the very, very early stages of what could be a new financial infrastructure. There's, of course, a lot of hype because of its long-term vision, that it's just starting to be usable by the end user. And it's being compared to something like the ICO, where it was all ideas and vaporware. It's refreshing in a way to be actually able to use these products that align incentives in a decentralized way. as I said, expectations may be getting ahead of themselves. So I would proceed with caution if you do decide to invest in these protocols, especially at this moment. Liquidity mining incentives are not sustainable. And this is something Vitalik, especially the ones that provide very high yields. This is something Vitalik has discussed. Essentially, by giving away so much of your supply, you're also lowering the value of it. And this is something some people are ignoring. I don't know if on purpose, but it might end up being negative in the long term. So it's more of a short-term boost to create liquidity, but it also encourages short-term users seeking just yield seeking rather than actually creating value long-term, which is a clear issue, of course. There are several risks and unintended consequences to consider. These can be mitigated in a way with protocols like Nexus Mutuals that can ensure your protocols. Also, if you do get a loan, I would advise towards getting a high collateralization rate to essentially avoid being liquidated. Do your own research, decide if you want to trust Tether or another stablecoin. And I would argue that analytics, and that's our hope with what we're building at IntoTheBlock, is that they're helpful so that you can track what's the actual value being created and differentiated from the hype created in Telegram and media in general. So just wanted to introduce our next webinar. Our team will now supply the link to sign up in the chat. It will be with our CEO and co-founder, Jesus Rodriguez. Make sure to sign up. And before you guys leave, I would love to dive into your questions. I also want to know if you guys have feedback. So as we showed you a sneak peek of what Insights is looking at, would love to hear if there's something particular that you guys want to see. What are your thoughts in general into what we're working on? Victor says, excellent presentation. Thank you, Victor. Thanks for joining us. So Anton had asked before, do you think no retail is currently coming to DeFi from outside of the blockchain market? I think it's a great question. And I think because there's currently steps that you have to do, like prerequisites before using DeFi, I would argue that it's mostly redirected within the crypto space rather than new entrants. And that's because you need a MetaMask account, you need Ethereum. These processes have been made slightly simpler with apps like Argent. But I would argue that for us to attract actual retail users outside of crypto, we have to make these on-ramps from fiat to crypto way more seamless and with less steps involved. Ideally without like a pop-up opening up to unlock this and unlock that. I think it has to be much simpler if we do want new users entering. Few more questions. How do you determine who gets to vote if trading? Oh, I already had answered this question, sorry. So Teddy had asked if I have an LP, so a liquidity pool, or a pooled asset fund that hosts beacon node and multi-validators, and I use the registered shares of fund to collateralize staked ether, what protocol? So a bit of a weird wording there, if I may say. I think something you might be asking is, can you stake ether within a liquidity pool? And as I'm assuming you're referring to ETH 2.0. And this is something I have done some research on, and I believe you should be able to. The details are still to be cleared out by the Ethereum Foundation, of course. But it would be great to see if you can simultaneously earn staking rewards while using your ETH as collateral in another DeFi protocol. I think that should be able. You should be able to do that. I'm not a smart contract engineer, but given the benefits of using collateral in multiple ways at the same time, I think it could be feasible. So some more new questions. Thanks for the great feedback. Marty, glad you liked it. Fernando asked, any big DeFi projects to look out for it that have value? So there's a lot of these that have underlying value. I can't deny that. There's actual network activity going on. I don't want to give specific recommendations. I'll give more of a broader sense of the protocols that do get usage. Not financial advice by any means, since their token prices have been overextended. But Synthetics does actually have users trading its derivatives, and it also has SNX stakers. So I believe 60% of their SNX token is currently staked in the protocol, earning rewards. And it has, I think, like 20,000 stakers. So that's relatively good amount of usage. Aave has a relatively good amount of usage as well. And they released Avenomics, which is a paper where they dive into the incentives. Another protocol, Uniswap, I would argue is probably the most successful DeFi protocol right now. Doesn't have a token, but that's also probably better in the sense that I'm more confident to say that they have value since you can't invest in it. Do your own research, of course, if you do decide to trade these. Do you think, Anton asks, do you think DeFi is the reason why billions of stable coins were printed? I think there's definitely demand to use stable coins in DeFi. I don't think it's the main reason. I still think the main reason for stable coins is to use for trading. Of course, the rewards that you can obtain from trading are much higher usually than the ones you can turn from the ROIs in yield farming and these schemes, incentive schemes. So I would still argue that stablecoins are mostly used and printed for trading rather than DeFi, even though the share allocated in DeFi has been growing for sure. Someone's asking what's the next 100x in your portfolio. Sorry, Dimitro. The people feel free to comment there. I'm not gonna comment financial advice there. Victor asks, from the analytics you've seen around DeFi, do you think there's a huge risk of a bubble forming? Well, unfortunately, there's definitely risks of a bubble forming. Like these protocols have less than 1,000 users a day, and they're valued at like over 300 million. So there's a very large divergence between the two. I think it's probably better, in my opinion, if they take a bit of a breathe or a break right now. It's probably better if it corrects right now and it calms down, the hype dies down for a bit. I think that's probably safer for the ecosystem rather than if you get a full-blown hype. I think that would hurt token prices and the protocols more. So I think it's probably better to manage expectations and have a level-headed approach industry-wide, in my opinion at least. So Carlos is asking, is it possible to rewatch presentation and where? Yes, Carlos. We will be posting it in our YouTube and our social media tomorrow, which should be live. Someone's asking, please dive deeper on a fractional reserve. I think you mean fractional reserve. So what I was meaning by that, and I'll go back to the slide. To get a loan in these protocols, they have to be over collateralized. And that's because these protocols essentially don't have like a credit check to trust people using it. So they have to provide over collateralization in case the collateral also drops in value. However, people have been gaming these schemes, these incentive schemes like yield farming, by essentially providing the liquidity that they had borrowed and resupplying it to the same protocol. So this is a simplified chart of how this looks with DAI specifically in Compound. As I mentioned, the market cap of DAI in Compound, so CDAI is 10 times greater than DAI. And I believe that's mostly because of this recycling that is going on. And if you're resupplying the DAI that had already been previously borrowed, you're supplying artificial collateral. So essentially, it drops the collateralization, possibly below the 100%, which makes it under collateralized and more like fractional reserve banking system that we see in the traditional finance world. So So Anton's saying, I think that the low number of users is partially caused by high fees, definitely. I think if ETH gas fees drop, there's also a learning curve. There's also education that has to be done. But if right now, if you use a protocol and you want to get, I don't know, a $20 loan and the gas cost is $15, it's definitely not worth it. So as there's more scalability solutions and some of these protocols move to layer 2 solutions, the gas costs should go down and usage as well. Victor is commenting, is it possible to distinguish between the percentage of users yield farming versus the percentage of users actually using the protocols? Fantastic question. I think it's something we have to do more research on. I think since you're just supplying liquidity, it would be hard to tell. But you might be able to tell in their patterns. Maybe our engineering team can find some AI clustering tool to classify those. I think it would be very interesting to look into that, and it's something we'll definitely research. Okay, well, I think great questions. Thanks, everyone. Thanks for joining us. Sorry about the issue with the Wi-Fi midway. Hope you guys enjoyed, and make sure to keep an eye on our release for insights. If you do have more feedback or questions, I would love if you guys send me more information on what you think and what you would like to see in IntoTheBlock Insights. Just feel free to email me or even DM me through Twitter. Thanks for joining us, everyone. Hope you guys have a great day wherever you're at.